In today's episode, I'll talk about two interesting stories. In the first story, I'll talk about the latest quarterly results of housing finance companies, and we'll take a look at what this tells us about the overall sector for you and me as investors and people who track the markets. And in the second story, I'll talk about why remittances are so important for the Indian economy and how exactly it benefits us. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is very easy for you to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Friday, the 7th of February. With that, let's begin with the first story of the day. Recently, the quarterly results of housing finance companies for the third quarter of FY 2025 came out, and like we always do on this show, we'll take a look at some of these results of the top players and get a sense of what is happening in the industry and where it is headed from an overall perspective. But to give you some quick context before I begin, a HFC's main job is to provide loans to people who want to buy or want to build homes. To do this, they first borrow money from various sources like banks, bond markets, etc., and they lend this money to customers at a slightly higher interest rate. The difference between the rate at which they borrow and the rate at which they lend is called the net interest margin, or NIM. Now, because home loans have slightly lower interest rates as compared to something like a credit card loan, HFCs do not make huge profits on every single loan. Instead, they actually end up relying on larger volumes of loans in order to earn their money. Now, currently speaking, the housing market of India has been showing some signs of slowing down. After the COVID-19 pandemic, there was a housing boom in our country where more people rushed to buy homes. This eventually caused housing finance companies to lend more money, obviously. But this kind of breakneck growth was obviously not going to last forever. And as a result, the market is now returning to a more normal speed. According to property research groups like Knight Frank and Anirok, both the number of new housing projects and the number of people buying new homes have been dropping lately. Over the last year or so, housing sales in India's top cities slipped by around 4%. And because the real estate market is slowing down, the demand for home loans has also dipped as a result of it. The RBI reports that loans to both home buyers and to housing finance companies have grown more slowly than they did before. One more challenge for HFCs is that banks which often lend them money have made borrowing more expensive as of late. This is partly because of RBI's move to increase the risk weight on loans that banks give to finance companies. When the risk weight goes up, it becomes costlier for a bank to lend money to a housing finance company. So as a result, the HFC or housing finance company ends up paying more interest. Now, some of the bigger HFCs can still raise money by issuing bonds and non-convertible debentures, or NCDs. But the thing is, smaller ones may not find it so easy to do that. And as a result, all HFCs, either big or small, are now starting to feel the squeeze from higher borrowing costs. But home loan rates still remain competitive, and this means these companies cannot simply charge higher interest to their customers in order to make up for these increased costs. And that is why the margins are getting squeezed and profitability is coming under pressure to an extent. Now, all of this was pretty much like a background of this sector. But to understand things a little more better and a little more specifically, let's look at three companies that have recently released their quarterly results. We look at Bajaj Housing Finance, LIC Housing Finance, and Aavas Financiers. Now, each one of them had to navigate these same broad issues of a slowing housing market and more expensive funding. But still, they have all approached these challenges in slightly different ways that is very interesting for all of us to know about. Let's start with Bajaj Housing Finance. Now, one thing you need to know here is that Bajaj Housing Finance has only very recently been listed on the stock market. So this one was their first full quarter of results for all of us to see. Now, Bajaj Housing Finance clocked an impressive 26% growth in its total loans, which are often called assets under management, or AUM as well, compared to the same period last year. Now, this brings that figure to just over 1 lakh crore rupees. Its return on equity, or ROE, went down from 15% to 11.5%, largely because the company raised fresh funds during its IPO, temporarily making its equity base a little bigger. But as it puts that capital to work and increases its lending, the ROE is definitely expected to go back to around 13 to 15%. Now, one thing that stood out in Bajaj Housing Finance's results, it was a big jump of 57% in its developer finance loan book. Now, developer finance means giving loans to real estate builders so that they can construct residential or commercial projects. Now, I know at first look, this may seem a little strange in a market when new project launches are slowing down, but Bajaj has a specific reason for doing this too. See, by funding builders, they are hoping to be the first choice for home loans when buyers eventually purchase flats in those particular buildings. Bajaj also follows a sweep strategy for developer loans, which requires the builder to start making partial repayments as soon as they sell even one single apartment in the building that they are making. Now, this brings a steady cash flow and also reduces the risk of a huge default happening all at once just in case the market slows down. Now, whether this works over the long term or not depends on how many of these loans actually turn bad. But so far, Bajaj's bad loan numbers, or NPAs for that matter, remain very, very low. Bajaj is also expanding into near prime and affordable housing loans now. Near prime, by the way, means home loans of around 30 to 50 lakh rupees, while affordable housing is for loans below 30 lakh rupees. And because these are usually for borrowers with slightly lower incomes, the interest rates tend to be a little bit higher, which can definitely boost profits for companies like Bajaj. But that said, this also comes with a slightly greater risk of defaults. Bajaj sees a big opportunity in states like Andhra Pradesh, Telangana, Maharashtra, Gujarat, and Rajasthan, especially in Tier 2 and Tier 3 cities of these areas. Now that was pretty much about Bajaj Housing Finance. Let's now move on and understand LIC Housing Finance. Now this company, on the other hand, is dealing with tighter margins and slower loan growth. Its net interest margins, or NIMs, have come down to 2.7% from 3% a year ago. And one of the main reasons for this is that cost of funds has risen to 7.7%. Just so you know, LIC does not have a big pool of low-cost deposits like a bank might have, so it may have to rely on high-cost borrowers through bank loans and bonds. Now, it tried to push some of these rising costs onto borrowers by increasing its prime lending rate. This means new loans might slightly become more expensive, but it is definitely very hard to say yet if that is enough to keep LIC's margins healthy. On the good side though, LIC Housing Finance has been aggressively cleaning up its bad loans. It got rid of a large chunk of these non-performing assets by either selling them off at a loss or writing off the others. And this brought the overall bad loans count down from 4.26% to 2.75% over the year, which is a very significant improvement to say the least. But still, it has a problem with project finance, which are loans given to real estate developers. That has an NPA of 27%. And unlike Bajaj, which I just mentioned is growing in that area, LIC has decided to pull back from developer lending in order to reduce its risk. LIC's overall loan growth is also fairly slower, partially because of property registration delays in Bangalore and other legal issues in Hyderabad. But that said and done, there is definitely a glimmer of hope. LIC is launching a special unit in order to focus on affordable housing segments, hoping to charge interest rates that are few percentage points above normal housing loans. This can bring higher profits, though higher profits always come with extra risks as well. Moving on, let's talk about Aavas Financiers, which has taken a relatively simpler path. Now, it has always focused on affordable housing and has built much of its business in smaller towns, which are Tier 3 to Tier 5 cities. Around 80% of its loans are below 25 lakh rupees and close to half of them are actually below 15 lakh rupees. Now, while such loans do offer higher yields, which means Aavas earns a little bit more interest than usual, they are also much more riskier because customers in lower income groups can be more sensitive to a slowdown in the economy than the rest of the people. But even despite all of that, Aavas reported a healthy 20% growth in its total loans, going up to 19,200 crore rupees. It also disbursed 1,600 crore rupees worth of new loans, which was 17% higher than the previous year. Also, Aavas, just like other HFCs, has also felt the pressure of its margins, with its NIM, or net interest margin, dropping by 40 basis points to 7.54%. A part of the reason is that Aavas raised the interest rate on new loans, but many older loans still carry the lower interest rates from before. It also borrowed a little bit more than it currently needs, keeping some extra money aside for safety. And that extra money is not being lent out right now, so it is not really making any interest on it, which adds to the margin squeeze altogether. Aavas also has very low balance transfers, which means fewer borrowers switch to another lender at just 5.4%, and this suggests that people generally stay with them rather than moving to a competitor. And that obviously is a positive sign. Another interesting development here is their shift to a more efficient loan management system, which they claim reduces paperwork and speeds up loan approvals. So if I were to put it all together for you, the entire housing finance sector seems to be grappling with two main issues right now. First is the slower demand for new home loans, and the second is the higher cost of borrowing. But still, like we just saw, companies are responding in different ways. To quickly summarize it for you, Bajaj Housing Finance is expanding quickly into new areas and developer lending. LIC Housing Finance is cleaning up its bad loans and inching to affordable housing, while Aavas Financiers remains focused on smaller towns and affordable segments because it has been doing well in it for many years now. So in the months ahead, it'll be very important to see for us if interest rates actually come down and whether that eases the burden of borrowing for housing finance companies. Because if cost of funds stays high while home loan rates remain competitive, then margins might shrink even more, which could make profitability a bigger challenge than it is currently. And at the same time, it'll also be very interesting to watch how developer financing unfolds to those who are lending heavily to builders. For now, though, the housing market is in a slower patch, and the performance of each housing finance company will definitely depend on how well they navigate both the reduced demand and the increased cost of funding. Moving on to the next story, let's talk about remittances, or the movement of money from people who work abroad back to their home countries. Now, I know this might not sound like a thing for you to care about at first, but if you look a little bit closely, and we will right now, you will see that these money transfers make a massive difference to economies across the world. And in order to understand what's happening here and why it's important, let's first take a very quick understanding of how unequal our current world is. Look, there are places like the richer parts of the globe where the average person earns far more than someone in a lower income country right now. And because of this particular gap, we often end up asking, how can money reach people in poorer countries without angering those in richer places, and also without causing other economic problems? Now, different experts over time have tried different and various methods, like financial aid from government, special loan programs, or big investment deals for that matter. Now, these of course can be helpful sometimes, but the problem is that they also come with challenges like complicated paperwork, corruption, delays, etc. etc. But remittances actually offer a very refreshing contrast here. The total amount of money that flows through remittances each year is enormous, let me tell you. In fact, it is much larger than what the governments of the world spend on official foreign aid. Some studies even suggest that remittances can even rival or sometimes even exceed foreign direct investment, or FDI, which is a big deal. And the reason why remittances matter so much is because they go directly to the people who need them the most, which is families of migrant workers. See, when someone from a poorer country works in a richer country, they can usually end up saving enough money and send a share of their earnings back home. Even if this amount seems small when they work, the difference in living costs and average incomes means that the money can have an enormous impact once it arrives in the home country. Families end up using these funds for all sorts of essentials like food, education, healthcare, and so on and so forth. And researchers who have looked at these money flows have also noticed that households receiving remittances often include children, older people, or women. This pattern shows that remittances help the most vulnerable in a society. Also, these transfers tend to stay steady or even increase when times are tough. In moments of crisis, workers living abroad usually try harder to send money so that their families can cope up. And this is very different from other kinds of investments that might dry up during economic downturns. And this explains why remittances are also seen as counter-cyclical, which means they often go up a country's economic struggles, which helps smooth out the hard times. Now, there are a few places that stand out in terms of receiving these funds. India is currently at the top of this list with over $100 billion in remittances in 2022 alone. Mexico and China are also large recipients of this. And that said, when you look at that as a share of the entire economy, smaller countries can actually depend on remittances even more. In countries like Tajikistan, Nepal, Lebanon, etc., remittances can end up making anywhere from a quarter to nearly half of their entire GDP. And without money from workers living abroad, these nations would actually end up struggling to keep up basic services and support altogether. But the flip side of the story is that sending money home is not always easy or cheap too. On an average, it costs about 6% of the total remittance in fees. In some parts of the world, like certain African regions, the cost is even higher than that. Now, these expenses usually include bank fees, exchange rates, and usually even hidden charges for that matter. And to make matters worse here, many people who need to send money or receive money lack access to proper banking services as well. They might not have an account for a reliable digital payment option, which forces them to use much more costly methods which cut into what their families actually end up receiving. And this is such an important issue now that the United Nations wants to reduce the global average cost of sending money to 3% by 2030. Some countries are trying to move in this direction by making the fees and exchange rates more transparent in order to encourage competition among money transfer services or linking up banking systems across borders. When the United States and Mexico tried integrating parts of their banking networks, for example, people ended up paying just a fraction of what they used to in fees. Now, for countries like India, where we earn a huge sum from citizens abroad, these transfers have become the second biggest source of external income after service exports for us. They even exceed the net amount of direct investments that foreign businesses bring into our country. And to put it in another way, they help make up for the loss in India's trade deficit. The total value of remittances adds up to about 3.7% of our country's GDP, which is roughly the size of India's entire financial services sector or our petrochemicals industry for that matter. And mind you, that is massive. And what is striking here is how quietly all of this is unfolding. It isn't really driven by large companies or big government schemes really. Instead, it just happens every time a parent, sibling, child, etc. sends a part of their earnings to relatives far away home. And that is why some analysts also call it one of the most overlooked ways of helping people in poorer parts of the world. If remittance fee comes down, it could really unlock billions of dollars more for those families and give them a chance to invest in better education, healthcare, and a more secure future overall. And ultimately speaking, this simple act of sending money back home might be one of the most powerful tools that we have to bridge the gap between the richer and the poorer countries. That brings us to the end of the two stories of the day. Let's now move on to the final section of the day, which is the quick news headlines. First, Swiggy reported a net loss of 799 crore rupees in third quarter of FY 2025. This is a sharp increase from 574.4 crore rupees in the same period last year. The higher losses were driven by increased capital expenditure on quick commerce and infrastructure investments. But despite this, revenue surged 31% year over year to 3,993 crores, with total consolidated income reaching 4,095.8 crore rupees. However, adjusted EBITDA losses widened by 149 crore rupees, primarily due to ESOP charges and higher depreciation costs. On the brighter side though, Swiggy's B2C gross order value or GOV grew 38% year over year, signaling strong consumer demand. Second, Adani Green Energy Limited or AGEL is in discussions with Indian banks to raise 2 to 2.5 billions over the next 6 to 8 months to accelerate its renewable energy expansion. Currently adding 3 to 4 gigawatts of capacity annually, AGEL is aiming to increase this to 7 to 8 gigawatts per year in order to meet its ambitious 50 gigawatt target by the year 2030. A significant portion of this growth will come from Khavda, Gujarat, where the company plans to scale capacity from 2.4 gigawatts to 30 gigawatts by 2029. Third, trading volumes in the NSE derivatives market have dropped significantly following SEBI's regulatory measures introduced in October 2024. Equity futures average daily traded volume or ADTV fell 15% to 1,71,825 crore rupees, and equity options saw a 7% decline, dropping to 61,295 crore rupees. That's all the news and stories I have for you today. I hope you enjoyed this episode and maybe learned something new from it today. As usual, this is your host Anurag signing off. I'll see you in the next episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.